Welcome to CrushTheStreet.com's weekly wrap-up. 20 years from now, history will remember September 13th, 2012 as the beginning of the end. The eye of the fiscal storm, already brewing from a decade's worth of inept and myopic decisions, touched down here in a packed Washington briefing room. This day that would have gone down as an otherwise unremarkable period has instead been used to launch the worst heist of personal and financial liberties the great United States of America has ever known. Its citizens will remember forlornly the days when an average car's gas tank could have been filled for $60. $60! A premium loaf of rye bread could have served dinner tables across vast neighborhoods for $5, and sometimes $3 when corporate subsidies, known at that time as coupons, were distributed during periods of unbalanced supply and demand dynamics. Supply and demand. What a brilliant concept that was. Did you know that in America there once was a time when free markets dictated the direction of the price? That the government's primary job was to protect the borders and the law of the land? That it left free men and women to decide the opportunities they would seek based on the concept of free will and the driving power of incentive? Taxes were once levied as an honorable duty of citizenship and not as a means to disguise financial lunacy. Those were the days of a free America. Now is the rise of the technocracy, the beginning of the end. Alright, let's move over to your weekly market update. By now, you will have already heard about Ben Bernanke's official announcement of QE3. Of course, many investors, especially the commodity bulls, were expecting further quantitative easing, but what took nearly all by surprise was the aggressive scope of this third time's the charm merry-go-round. This time, we are looking at a $40 billion per month purchase of mortgage-backed securities until the labor market improves, which means indefinitely. As expected, this gave a tremendous boost to all sectors of the marketplace, with major indexes approaching all-time highs. However, the big question is, where's the volume? If we take a look at the Dow Jones Industrial Average, we see that today's jerry-rigging caused the index to be off about 5% of the record high of 14 grand. However, when we compare the volume levels at those 2 points, we see that there is a discrepancy of 41%. Also of significant interest and a huge red flag is the number of times volume exceeded 2 million. In years past, that threshold was exceeded on a weekly basis. For 2012, that number fell to 0. Let's move over to currencies. Simply put, the US dollar got bernanked. A lot of people were questioning where the Fed would come up with $40 billion. The answer is right here in front of your eyes. Remember that there's no such thing as a free lunch, especially if the government is picking up the tab. More stimulus simply means more dilution of the money supply, which further erodes the purchasing power of your savings and salary. Of course, what's bad for the dollar is good for the euro. It's been fist pumping its way to 130 ever since Super Mario delivered his own Euro trash version of QE3. With the new policies now officially confirmed, we should expect that these two trends will continue to ride their wave of momentum. Alright, let's talk about the metals. Gold shot up to new heights, securing the 1770 level under massive volume. The scared money simply ran to gold due to the inflationary prospects of a quantitative Christmas. And whether you believe in conspiracy theories or not, gold is where the smart money is right now. However, I'm looking for a better entry point. First, today's closing price is above the upper Bollinger Band, an area that history has shown cannot be sustained indefinitely. Second, yesterday's market action revealed that the MACD indicator was starting to lose steam and would have eventually triggered a sell signal. While it's often said that the technicals lead the fundamentals, whoever said that obviously never met Ben Bernanke, who otherwise ruined a natural runoff cycle. In either case, we may see a sharp drop in this and other sectors sometime in the near future, as manipulated actions by the Fed have a poor reputation in sustainability. Finally, let's take a look at silver. The same points of analysis apply to silver as it received the Bernanke boost to close at $34.78. In silver's case, the MACD was clearly about to turn over yesterday before the intervention. Much like the stories from Hollywood's Down and Outers, I don't hold much faith in this rehab session. The technical indicators are even more overheated than gold, and although we may see some marginal increases in the price, I'm thinking that a sell-off is coming soon. If you may recall, in an earlier video, I stated that silver could hit $35 before we see an appreciable pullback, and today's intraday high was at $35.09. Also, more importantly, you are competing in the world of the day trader, and no matter what your feelings are towards silver, day traders will always take real profits over theoretical profits. Seeing as how silver moved up over 30% in 2 months, you know that major profit taking can occur at any time. And that will do it for today. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit crushthestreet.com.